No dividend is safe. That's what the experts are saying. With the UK and the US currently going into full lockdown, a lot of companies are going to stop trading. For investment, this means a lot of companies are at risk of cutting their dividends. Now is the time to be extra vigilant in your evaluations if you're new and you're trying to start a portfolio. So today is the day that I've chosen to look at a tool that could be used when evaluating a company's dividend safety. Stay tuned, and I'm going to try and make this as simple as possible, unlike all the other complicated shit that's out there. If you're new to this channel, these videos are about me starting my investment portfolio. I've made a lot of mistakes in just a month and I'm trying to get back on track. At the moment, I'm trying to pick an investment strategy that I can put in place on April the 6th and start my new ISA. I'm leaning towards a dividend investment strategy. I like the idea of compounding dividends, and I also like the idea that most of the companies that you should be picking will still pay in a recession. That means that even though the company's stock value goes down, they'll still pay you some money just to keep your interest in them. And with all this horrible coronavirus shit, a recession is exactly where we're heading. Since social isolation and social distancing started to happen, companies started closing. McDonald's decided to close this week, Primark decided to close this week, and a lot of other companies are now shutting down today. That's already caused quite a few companies that pay good dividends to announce that they're slashing theirs. Already this week we've got Ford, Boeing, Wetherspoons, William Hill, M&S, and one of my favourites, ITV, decided that even though on its website it was dedicating itself to its 8p dividend this year, it's not only slashing the 2020 dividend, it's going to slash this one right now, where the ex-dividend date was coming up in about 10 days or something. It's a bit annoying because in the last video I said I was going to cost average down onto ITV because they said they were keeping their dividend. Now they're not. That cost averaging has ceased. I'm not going to be buying into ITV anymore because it's not going to deliver anything right now for possibly the next 2 years. It doesn't mean I'm going to sell it though, because I still believe in the company. I still believe it's going to come back, and I still believe it can regain all of the loss that it's made for me so far. The coronavirus shutdown is decimating some big companies, so we can't assume right now that any dividend is safe. If you're in the early stages of a dividend investment portfolio, you have to be extra careful with which companies you're going to invest in. So you're going to have to look at them a little bit harder. Today I want to look at companies who have been around for a ridiculously long time and have paid dividends for a ridiculously long time, and I also want to show you how the dividend cover tool might fit into your decision making. If you look up dividend cover, it's going to show you a little formula which relates earnings per share to dividends per share. I don't really want to look at formulas because this one's simpler than that. The dividend cover tool is as simple as the earnings per share just being a little bit higher than the dividend per share. It's very simple. If the earnings per share is even a little bit higher than the dividends per share, as in the dividend that it pays you, then it's able to pay its dividend with the profits that it's making. Some companies don't do this. On their way down, they sometimes lend and they sometimes sell, and that bolsters up their dividend to try and get you to stay on board. And that's what we often call a value trap. I won't get into that now, just stay away from them. On a normal day, when we're trying to look for a company that's got a relatively safe dividend, we want to be looking for a company that has really double the amount of earnings per share than it does its dividend. A company like that is said to have a score of above 2, as in 2 times the amount of its dividend. A lot of those big companies out there that pay the big dividends usually have this dividend cover score of about 2. This isn't always the case though, and some of those big companies that have the big dividends don't always have the big score. McDonald's is about 1.99, 3M's probably about 1.6, and even the biggest UK dividend payer, Shell, has only a score of 1.5. That means that Shell has about half the amount of extra profit just lying around after it's paid its dividends. So it is still relatively safe. I mean, that number must be in the billions, right? In a long-term recession, a lot of that spare cash lying around is going to be very, very helpful. To take Shell, for example, because it's only got a dividend cover of 1.5, it's actually selling a lot of its assets and changing its strategy in order to raise some cash for this recession. I'm hoping that's going to be to keep its dividend, because I might invest in them soon. I think it's a good time right here to point out that dividend cover isn't the only thing you should be looking at. You should be looking at dividend history, you should be looking at a bit more of the balance sheet as well. But we're specifically breaking down this point today just so you get a good idea, and I'm trying to keep it as simple as possible. So, If you're looking for companies that are going to pay dividends straight after this recession and maybe even keep them during this recession, a good place to start is to make sure that their earnings per share are above the dividend that they pay per share. I'm just going to take it a tiny bit more complicated here for anyone who thinks they want to buy and try and keep a dividend during this recession. In a long-term recession, shit's different. Experts reckon that the only way you can really think that a dividend is even kind of safe is if it's got a dividend cover of above 4. Above fucking 4! That means a company needs to have 4 times the amount of profit in its bank. That means that company's got to be sitting on a fucking pile of cash. Or at least you just caught that company ready to start buying assets or upgrade its services or something like that. I had a bit of a look around for one of these companies and they're fucking unicorns. I had a good look around in the top dividend paying companies and the situation really isn't great. Shell 1.5, 3M 1.6, McDonald's 1.99. We only start to get over 2 when we start seeing Microsoft at 2.5 and Walt Disney at 2.8. But I did find a few top rated companies that do have a dividend coverage of above 4. In third place at 4.4 is Segro. Segro is one of my favourite REITs. I like companies that I've never heard of before I started investing. This is because they probably didn't have a scandal before I started. Segro's a big box REIT that's in the commercial sector. It owns a lot of big buildings in the UK and Europe and has quite a high tenancy rating. I already have Segro and I'm going to put a lot more in when my ISA starts. Next up we've got Visa. Visa shouldn't really surprise anyone. It has a dividend coverage of 5.2. It has a shit ton of profit behind it and it's one of those financial companies that won't really be as affected by the recession as say a bank would or a broker would or something like that. And it's because it runs lots of different credit cards, it runs e-commerce pages and things like that, so it should still generate quite a bit of profit. However, its dividend yield is very, very low. Its dividend yield is 0.85%. Now I don't want to get too much into what dividend yield is, but essentially when it's low, that means the company's stock price is super high and you're not going to get a good dividend return for it. And that's what Visa is. Visa's a super expensive growth company that only pays quite a tiny little dividend in comparison to the price you pay for it. So while I probably would still buy Visa because of its growth capacity, it's not really one that I'm going to specifically buy because it's got such a brilliant dividend. And I couldn't believe it, but the top dividend coverage company that I could find is actually a FTSE 100 company. RBS has a dividend coverage of 5.8 and it actually pays quite a good dividend in comparison to its share price. If you take this stat alone, it shows that RBS's dividend is very safe. Based on this single measure, RBS is really attractive right now. I haven't actually looked into the rest of it yet, but I do know that RBS is going through a lot of restructuring issues. It is going to pay out a lot of money when it decides to merge NatWest and RBS together. I think they're actually going to call it NatWest in the end. So it's up to you to decide whether it's actually a good investment at the moment. I still need to look in a bit further. But I bank with NatWest, I bank with RBS, so it seems like I should trust them. You've got to look at these companies' balance sheets, you've got to look at their profitability, and you've got to have a look at them in the news to make sure they're not doing fucking stupid things. This dividend coverage tool is not the be all and end all. In fact, all of the top S&P 500 dividend payers over fucking ridiculous amounts of years all have dividend coverages of lower than 4. And they probably did during all of the recessions that they've been through. Coca-Cola has been increasing its dividend for 55 years. It currently only has a dividend coverage of 1.3. Now, does that mean that they won't pay their dividend this year? I mean, anything's possible. But when they have delivered for so long, you can't help but think that they're going to find a different way to pay their dividend. Johnson & Johnson has increased for 56 years, and that currently has a dividend coverage of 2.3. So on a normal day, it'd be relatively safe. Right now, it's not necessarily safe, but 56 years, it's probably going to find a way to keep that up. And Procter & Gamble has had an increase of 61 fucking years. 61 years of increasing their dividend. It's only got a dividend cover of 1.9. Again, on a normal day, pretty safe, but in a recession, not necessarily safe. However, surely they want to keep that trophy. They are the #1 dividend payer in history. If the current coronavirus measures stay in for like 12 months, and the recession continues all the way to the end of the year, there are a couple of companies that I'm really worried about. AB Foods is one of my favourite companies. I like Primark, I like how it works. It's pretty unethical, but it's a big retail company in the UK, and it's probably one of the only ones that are still doing really well. It's got a good dividend coverage of 2.9, but its stores are fully closed all over Europe and even in America. Primark could not be making profit for well over a year. That's really fucking scary because they must have really tight margins on all their products anyway, and the rents for those stores must be massive. I'm really worried about that family-run company keeping its dividend. Also, McDonald's is running quite tight at 1.6, and a couple of days ago they decided to shut all of their stores in the UK. It's got to be coming from America too. The profit loss on that is going to be horrendous, and while they have a lot of capital to you and me, it's probably not a lot of spare cash when in comparison with their debts. This has come for a very bad time for McDonald's, and again, I'm worried about their dividend. With so many other companies slashing their dividend, McDonald's is surely to follow suit. Companies I am looking at though, RBS because of its massive dividend coverage, and also Microsoft. Microsoft's a funny one for me because I don't want to treat it like people are with 3M. People think that 3M manufacture the masks and people are buying shit tons of masks, so that's how 3M's going to weather the storm. It's not. It can't possibly do that. 3M is a much bigger company than simple masks. It's the same with Microsoft. Microsoft's got a very safe dividend coverage, but what I've seen is a lot of people working at home. And all of those people working at home are now using Microsoft Teams where they wouldn't have used it before. That's including the NHS. Every NHS worker who can work from home has been sent home and is working on Microsoft Teams. The NHS and other companies that didn't realise that their workers could previously work at home might start doing that. That means there could be a lot of new subscriptions coming from Microsoft Teams, and one of those big players could be the NHS. That's just a theory I'm working on at the moment. Microsoft's generally quite a good company to invest in anyway, so with all that going on, and probably half the world learning that they can actually work from home now, I'm really leaning towards going heavy on Microsoft. Okay, just to recap, keeping it really simple, dividend coverage is the comparison of how much a company earns per share to the dividend it pays out. If it's got more earnings per share than the dividend that it pays out, it's very likely that that dividend is kind of safe because it's not being paid by debts or asset selling or anything like that. If you see a company with a really high dividend coverage, it's then up to you to have a look at all the rest of the company and see if you like it. It's kind of just like the PE ratio. It's just like one of the first things you should look at, and if that ticks the box, then it's worth looking at a bit further. Things like PE ratio and dividend coverage can be made really, really complicated with percentage ratios and the ratio that I was talking about of 2, 3, 4. Just try and keep it really simple, because when I started looking at it, I was well confused and I thought this is way above my station. It's not actually that hard. And if you just think about it in different ways and slightly more logical ways, it can be quite easy for you to evaluate a company really well. If you're a new dividend investor looking for good companies, just remember, if the earnings per share is higher than the dividend that they pay out, then it's a good start. As usual, please do not take this as solid gold advice. I'm still not a financial advisor and I'm still starting up my own investment portfolio. You're just following along with me, and you can learn from my mistakes, like my latest ITV debacle, and not have to go through the pain that I'm suffering. That's all for today. I hope you're all enjoying yourselves in lockdown. It's really helpful that people are using my link still to sign up to Trading 212. If you use that link to sign up to the platform, we both get a free share. And as usual, if you found this video helpful, please like, subscribe, and invest.